The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the Option Block. With your host, Mark Longo from theoptionsinsider.com and co-hosts Mike Tusaw from KnowYourOptionsInc.com and Mark Sebastian from OptionPit.com. The Option Block is brought to you by Options Express. Don't spend time worrying about your broker. At Options Express, security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets, established financial stability. Options Express lets you trade with confidence. Stocks, options, and futures, all in one account. Trade with a specialist. Visit optionsexpress.com/OXradio to open your free account. Options Express is a member of FINRA, SIPC, and NFA.
All right, everyone, that rocking theme means that it is time once again for the Option Block, everyone's favorite bi-weekly source for options news and information and analysis and a wee bit of joking and clowning around. My name is Mark Longo from theoptionsinsider.com, as well as the ever-expanding, ever-exciting Options Insider Radio Network. And joining me on the old Option Block All-Star program today, starting off, beaming in all the way from lovely and scenic St. Charles, Illinois, is none other than he of the smoking jacket himself, good old Uncle Mike Tusaw from RCM. Uncle Mike, welcome back to the show, sir.
Always happy to be here.
You sound so deeply enthused, sir.
I have to be honest, I have one eye on my streaming quotes right now as we're doing this show.
Gee, I wonder why.
Well, like we were talking about before we went on, another boring day in the marketplace.
Another quiet, boring day, not too much to talk about. And to help us discuss that very, very boring day, we are also joined by Alex Jacobson, a.k.a. the Viceroy over there at Options Express. Alex, welcome back to the show to you as well, sir.
Good to be here, Mark. I don't think boring adequately describes it, but we got a lot to talk about today.
Yes, and hopefully joining us a little later once the Skype gods sort out their issues will be either Andrew or Mark from Option Pit. Both of those guys scrambling over there, as you may expect, because there was a wee bit of action lighting up the old tape today. So I think without further ado, we shall roll right on into the trading block.
The Trading Block.
All right, and welcome to the Trading Block. This is, of course, where we discuss what was going on, what was trading, what was moving the old markets today. And if you weren't paying attention to yesterday, as you listen to this now, if you had your head under a rock, then you missed this pretty surprising and aggressive bloodbath, wiping out a lot of gains on the street today. He'll start off in the broad indices, then we'll move a little bit farther afield. S&P closing today down about 2.3%, or nearly 37 handles to 1552. Dow falling a little bit behind, down nearly 2%, or 265 handles to about 14,600, and the NASDAQ leading the charge down 2.4%, or 78.5 handles to 3216. Of course, that wasn't the extent of the bloodbath. No. There was some aggressive selling going on out there in precious metals land, with gold just leading the charge to the downside, getting just wiped out today. Down nearly 9% on the day today, with GLD closing at 131 and making for a combined two-day record between Friday and today for pretty much the worst two-day decline in 30 years for gold. So this is really for all the gold bugs out there, all the metal heads who've been writing into the show, asking about metals, looking into GLD and SLV, and of course the big futures and the futures options, and looking how to trade them. And we of course have discussed metals on this show many times in the past. A lot of you really getting your wings clipped if you weren't covered to the downside, or if you were looking for some more upside bump here in gold. And a lot of this coming, and pretty much all of this bloodbath, are really coming out of the surprising announcement coming out of China that things are starting to slow down over there a little bit. You know, we've heard for years now this mantra coming out of China that it is just double-digit growth and everything is exploding, and they are the tiger of all of Asia, and they will drive all of the growth going forward. They will be the engine of the entire economic recovery. They will be the leading economy in not too long in the distant future. All these things that have pretty much been just conventional wisdom since the mid-90s, and coming out today and saying, well, the president at least saying China's model of development is not sustainable. So it is imperative for us to speed up the transformation of the growth model. And this is, of course, China being a very closed economy, closed country. When they come out and say things like this, it is somewhat surprising. And all of this bloodbath really coming off the fact that growth just dropped to 7.7% in Q1. So that would be pretty resounding growth for pretty much anywhere else in the world. But for China, they've been expecting double-digit growth every quarter. South of 10% is really a slap in the face. And, of course, these numbers being so tightly controlled coming out of China, if they're willing to announce 7.7, I might guess the actual number might even be lower. Who knows? Who knows what the actual truth is there? But regardless, the narrative coming out of China, not exactly positive, and that really crushing a lot of things, including gold, of course, a lot of demand for precious metals coming, and all pretty much resources of all kinds really coming out of China in the last decade. So that's crushing everyone across the board. We'll start in gold land. I know, Uncle Mike, you've been saying on the show recently that you were hedged and you were kind of letting the upside swing free because you thought that was kind of where some of the action was going to be. I bet you're very happy to have that hedge in place over the past week or so.
Well, a wise man once said on this show that a lot of times big market moves are preceded by low implied volatility in the options. With that in mind, what we've been doing with GLD and SLV for that matter, we've just been long puts, and so right now we're long the puts combined with being long the underlying, and so we're just hedging it in case something like this happens, but we're going to let the upside ride. And that was one of those things that, obviously I would have preferred to have been short gold over the course of the last 2 days, but where we were at, we're long the 150 puts in GLD. And so this movement that we got over the weekend really didn't harm us that much. And we're actually long the 28 puts in SLV. And I remember just thinking, well, I'm probably going to roll these things down, and I was on the borderline of when I wanted to roll down the puts to capture some of the premium to the downside, but I decided to wait over the weekend, and obviously I'm glad I did for that matter. With it though, with the announcement from China, I mean, I know that we talk about gold bugs in terms of if you ever say anything bad about gold, you get stuff thrown at you, but I don't know if I'm necessarily ready to throw stuff at people, but I still do have a long-term sentiment on gold and silver being bullish to the upside on it. And I think it's just things like this is why you do the collar, folks. Mama said there'll be days like this, and this is why you do such a thing.
So given your long-term stance on gold, do you envision any time in the near future perhaps blasting out those puts and then flipping to the short side and selling to maybe add to the overall long position at these levels?
That's what I'm analyzing tonight. What I was doing today, by the way, the BBI index, this is a record BBI index day for me too. I'm going to be busting a kidney. With the BBI index today, what I've been looking for all day is that I wanted to, like when I saw this in the morning, or I was looking at the my futures early, like my typical routine, I wake up early, go work out, and I always look on my smartphone what the futures are doing pre-market, and so I reloaded it several times to make sure that that was correct when I looked at it. But my plan today was to analyze which put I was going to roll down to, but we never really had any type of upside movement in gold or silver to justify doing that. I want to see at least some type of upside on there before I do it. So right now, what the clients are in gold and silver, they're in a complicated cash position when you break it down.
Yeah, when you look at it that way, it certainly does. It does kind of analogous to cash in many ways. And I'm sure this is just another example of why your clients are happy to have you managing their money, Uncle Mike, because you have that little put in place to let them sleep at night on days like this. And, Mama said there would be days like this. So she was quite a wise woman. Alex, what was rocking the old tape? I'd imagine a lot of things were going on at OX today. I'd imagine the phones were really lighting up, and it was just a crazy, crazy busy day. Was gold leading the charge over there as well, or was it, a SPY? What was driving the bulk of the consumer interest / concern today over at OX?
Well, the futures guys, it was gold and oil. The equity guys came in today, and the first thing that lit up the phones was Priceline. Down $30 after the negative Barron's article. But a little bit after the opening, I have sort of this benchmark of listening across the desk. It just sounded like it was everything. It just sounded like it was continuous. It was Apple, it was Google, it was the GLD, it was the SLV. It was just everything. It was just a constant day. I mean, today was pretty much a macro bloodbath. I mean, we talked about this last couple of shows that the market seems to be driven by macro events, and today we had the textbook macro event. China slowing down, the rush out of gold, the rush out of energy, the rush to quality. The 10-year couldn't hold 1.7%. The U.S. 10-year rallied, the German 10-year rallied, the UK, all of sort of the safe havens rallied. The Japanese 10-year, which I know it's a little overly dorky and academic every time I bring it up, but the Japanese 10-year, which has had extraordinary volatility in the last few weeks, lost 7% in value today. So a week and a half back when I was talking about the extraordinary move in the Japanese 10-year, and it's reversed itself, and it's actually at a higher yield than when this whole thing started. So it was macro events today, and they basically pulled the carpet out of anything commodity related. So it's a slowing economy in Asia, and everybody's concern is that's going to ripple over here. But some of the biggest losses today were the big cap energy stocks. Crude lost $3, but if you looked at Exxon, Conoco, they just all got murdered, and everything related to it got murdered. So it was not an easy day for the men and women on the phones here today. It was just constant. And it was bloody.
Do you ever get the urge to just pick up the phone every now and then and just jump in on a call or two just for old time's sake and just to refresh the old memory, the muscle memory?
We do that with all new employees. We actually make them sit with one of the desk people on a second headset, and I'm socially challenged because I'm one of those people, when I hear what's going on, I literally want to get on the call, which I'm not supposed to do. But yeah, you get an itching on a day like this. Kind of with one eye, you're watching your own portfolio. Kind of with the other eye, you're watching the business and what's going on the desk. We had this news right near the close about the bombing in Boston, and now the reports are it appears this is going to be a tragedy with some scope. There's a couple people reported dead already, but it's kind of early times in these events. Today was a news-filled day. For people who trade, for people who look at volatility, I know this is going to be a day, back when the floors were full of people. Today was the kind of day when someone came off the floor and said, I had a good year today. And the three people down the line said, I had a bad year today. Volatility got a big lift today. VIX up over 4 points. And a lot of that came in the last few minutes when the Boston news hit. So there was a lot going on
given
today.
the way the markets closed, given the obviously awful news coming out kind of right towards the end of the day into the close. I would be surprised if we open up tomorrow. I think we might see even some continued extension of some of this, I hate to use the word bloodbath given what's been going on, so perhaps another choice of words at the moment, but just sea of red out here on the street today. And of course, this extended to a lot of different names. We haven't even had a chance to talk about some of our usual suspects on the show today. I know, Uncle Mike, you were so busy watching GLD. Did you have any other love for any of your other typical holdings? Apple, of course, selling off 10 handles at 2.3% today. Ford selling off nearly about over 4% or about 60 cents today. Any action out in those two for you?
No, I mean, this is one that I still, from the last 3 or 4 weeks, I've been trying to be very cautious with getting into new positions or expanding onto positions. And I'm going to talk a little bit about this more in the strategy block today. But risk management, there's a big difference between risk management and market timing. And I'm going to reiterate that again today, just because I think we need to talk about it again to emphasize on a day like today, when markets move a lot, do people know that the market's going to continually go up? No. I'm the biggest long-term bull on this show. I'm willing to bet. And I want to really reiterate the importance of risk management, because you got to be prepared for days like this. And I want to go over exactly the steps with which we took to prepare for this and why we did it. And in terms of other things that I'm watching, I did adjust Apple I had a 450-500 bull call spread on Apple for May. It wasn't a large position, but we did have that on. I did adjust that from, I bought to close the 500 calls and sold to open a weekly 450 call and turned it into a bullish call calendar. But other than that, I've been very much trying to be cautious with the big run-up that we've had.
Yeah, there certainly are many different areas to explore and potentially look for opportunities in a day like today with everything selling off so aggressively. I've mentioned before on the show I've been active in Ford quite a bit of late. I know a few months back I overwrote a collar after having been long a lot of underlying. I had been writing a lot of options against it. Before it blew through that level, I ended up getting short a bunch of stock, which actually has been good. I've been trading in and out of that quite a bit. But I mentioned several times on the show of late that I've been trying to get out of this short stock I've had for a while now in Ford. I've been even pretty aggressive with it, writing 13 puts again and again and again. And this is my third or fourth tilt at that windmill in as many weeks/months to see if I can finally give back that stock. So far, Ford has refused to take my stock back, which has not been a bad problem. There are many worse problems to have. I can keep writing that 13 strike all day. But it is kind of funny to see just where we're vacillating in, and perhaps this is the time, and I could readjust my Ford going forward. Alex, anything else catching your eye in today's activity before we keep on rolling into our next segment?
I'm going to sound like a broken record. It was just everything got slammed today. They took everything out and they beat it with the "you're going down today" stick. I'm looking at Apple, Amazon. I'm looking at all the stuff that I look at. A lot of energy related stuff. They killed the financials today. Goldman was down a couple bucks. Eli Lilly and the drugs off a buck. Stuff that had been hitting new highs today. Another name a lot of people trade, which had gotten beaten up, Lululemon, had come back and was actually taking out the near-term highs and was actually up, I think, $1.25 this morning, and it got hit at the end of the day. Today was just everything. I know it sounds like a broken record, but today they took everything out and they sold it down.
All right, and that is going to do it for the trading block segment. And now, because we were so overwhelmed with other activities going today, we didn't have a chance to really pull a lot of unusual activity from the site. And in a day like today, pretty much almost everything is unusual. So highlighting one or two trades is somewhat difficult. So we're going to keep on rolling right on into the Express Block.
The Express Block, brought to you by Options Express. Options Express lets you trade where and when you want for every level of trading. From advanced charting, free daily trading ideas, and free educational resources, Options Express is the online broker for all traders. Best of all, Options Express allows you to trade stocks, options, and futures all in a single account on powerful yet easy-to-use trading platforms, including mobile devices. Visit optionsexpress.com/OXradio for your free account. Options Express Express is a member of FINRA, SIPC, and NFA.
All right, and welcome to the Express Block. This is, of course, the portion of the show where I hand the reins over to Mr. Jacobson over there in the land of OX, and he takes us behind the curtain of Options Express. Mr. Alex, a.k.a. the Viceroy, what is lurking, what is going on over in your neck of the woods behind the curtain of Options Express?
So behind the curtain with the pop and vol, if you are somebody who wants to sell some risk-managed premium in this environment, the even what I'll call the good names, the Amazons, the IBMs, are trading vols. Amazon is up in the 40 vol territory. I know we talked about gold, and I'm not rushing to sell premium in gold, but gold was trading less vol than the S&P, which, as Mike pointed out earlier, should have been a clear warning sign. But vol has popped in gold and silver. Apple vol is over 41%. IBM vol, which has been sitting in the teens, is up in the mid-20s. If you look at this event and think this is an opportunity that maybe the market overreacted and you're a put spread seller, come to the Idea Hub, look at some of the credit put spread ideas, but make sure you're comfortable with the names. Make sure that you're comfortable with the break evens before you pull a trigger. One thing I point out is never do a trade just because the rate of return numbers look good. A day like today, if you look at movement in the market today, a 2% move in the market in the S&P is a 32 annualized vol. So we moved more than the implied volatility in the market. These are the days that option buyers make money, but you'll look back at times like this and say, look, I really wanted that second chance to get into Ford, or I really wanted to buy gold on a dip, thinking about buying it on Friday. Maybe I'm glad I didn't. On days like today, people who have a good sense of implied volatility can cherry pick ideas in general. So I'd be looking at some of those. Keep in mind there are bank earnings coming out this week. JP Morgan, which posted earnings last week, didn't really correct much, pretty much moved with the market today. Citicorp today had good earnings. If you want to try to bottom fish on some of those stocks, look at selling puts or selling put spreads. It's the Warren Buffett adage about you make money when there's blood in the streets. And today there was blood in the streets.
Indeed, there was. And yeah, a lot of interesting opportunities floating around. This is kind of the reverse of what we've been saying for a while, and all this gradual run up as vol continued to erode out of the marketplace. Now we have one or two nice little shocks to the system, and it pumps a little bit of juice back into this market here. I'm just looking at the City Straddle where it went out yesterday. It looks like it was trading trading around $2.50-$3 prior going into earnings. So it's like it underperformed a bit, but still some interesting movement. City closing about unched on the day, up about 10 cents to 44.87 on the day. They, of course, had earnings before the open today. City being even up a dime, being one of the few bright spots on the street today. Not too many green tickers on my screen today. The only other one I can see that's notably up is really it's Netflix. Netflix, for some reason, up nearly 2% today. I haven't had a chance to check out the news there, what was going on in Netflix, but for some reason, even though the rest of the street was getting slaughtered, Netflix rallying 2% on the day. I guess it was a good day for streaming video.
Yeah, I hate to become a fundamentalist on a day like today, but if you look at, the stuff they murdered today, big oil, telecom, if you think rates are going to tick lower and the economy is going to slow, the trend for the last year or two has been buy high yield stocks, and if you're option centric, sell some out of the money calls against them. A lot of those names got real cheap today because they got thrown out, with everything else. AT&T, Verizon, Exxon. I could go down the list of kind of all the household names. If you look at them based on yield, Intel has earnings this week. In fact, Intel has earnings tomorrow. If those earnings disappoint, and we've seen all the news about computer sales, but if those earnings disappoint and you're a yield-based buyer, you can buy Intel almost at a 4% yield. Now is that exciting to option folks? Again, you can sell out of the money premium against it, and you can turn that into a home run if it does nothing over the next year, just based on yield and premium collected.
Intel, my old stomping grounds, and one I still pay quite a bit of attention to. We'll get to them in the Around the Block segment as well, of course, but they are coming out tomorrow after the close. Of course, we said last week that this is going to be the week where the story was earnings. Macro events have a way of intruding upon that belief, and it's certainly happened this week, but we'll see at Around the Block what exactly we're all looking at. But until we get to them, we have to keep on rolling with our next segment, which is the old listener mail block.
Now it's time to empty the mailbag and see what our listeners have to say. It's the mail block.
All right, and welcome to the old mailbag. And I know a lot of you have been asking me, hey, where's the mailbag? Why haven't you answered my question? So we wanted to grab a few minutes today. We haven't had a chance in the last few shows. We had guests and a lot of other things going on. So we grab a few minutes today, despite the craziness going on in the markets, to answer a few of your questions. Starting off with a question from Mr. Phil Bickers, coming out of Binghamton, New York, sunny upstate New York. About an hour from where I went to school up there in the deep south of the Northeast. But I digress. Anyway, Mr. Phil writes, if I buy 10 regular contracts with 5 minis at OX, do they all count as a single trade, or am I going to pay the minimum plus the contract amount for each trade separately? So he's clearly talking about here, Alex, about buying 15 total contracts, 10 regulars, and 5 minis for some reason, and putting them together in one trade. Why don't you review it? I know we hit on it a little bit on the mini show, but why don't we run down it again, Alex, and how these are actually counted from a commissions perspective over there at OX?
Yeah, right now they're counted conventionally. So the listener's idea of buying 1 big and 5 little at this point would actually be more commissions than if you bought 15 of the littles. And I can tell you that I was in a meeting last Thursday where we had the discussion about transactions costs, and I'm kind of speaking candidly. I'm not going to sort of mince the point. At this point, they're the same commission schedule, and they're 2 unique trades. In talking to my friends in the industry, this is going to sound like a bad joke, but I think all of the brokerage houses, especially the people like OX, Schwab, I think we're all looking at this point with some uncertainty about commissions. The volume has been decent but not extraordinary in these. Today, volume was good, but today, of course, is not an ordinary day. And what I suspect will happen is one of the firms will pull a trigger potentially and change transactions costs. Now, I'm again being candid and speculative, which every time I do that here, I get a phone call from somebody who goes, find a better topic. But right now, they're expensive to trade if you're going to do a 1 and 5. I did a trade. I talked about this. I own 150 shares of Apple, and I pay the same commissions everybody else pays, and I did 15 of the minis because it's cheaper from a commission standpoint. I think as they gain traction here and as more names come up, we, the kind of e-commerce, call us discount brokers if you like, I think we're going to reevaluate these things as they get more traction, and we'll also all be competitive. So if one of us decides to cut rates, and I know we are looking at it and analyzing it, so I can tell you, looking behind the curtain, we are definitely looking at it. But I'm sure if one of us cuts rates, I suspect all of us will cut rates. But right now, cheaper to do the 15 little ones. When people ask the question, where's kind of the sweet spot in minis? Is it 3 contracts? Is it 5 contracts? my view is the sweet spot isn't till you get to 11 contracts, because then you get past the minimum commissions, and that's where on a per contract basis, it's cheaper. The trader who sits across from me, we were talking about this the other day, because somebody called in and wanted to sell, a couple of Apple out of the monies, which were trading for a dime. And you say, there's no way that trade can make money if the customer has to both pay commissions to get in and get out. So be aware of the friction. Be aware of the transactions costs. Markets in the minis have gotten a little better, but there's still some generous bid offer spreads there. And the market makers need to do a better job of that if they want traction. But right now it's the regular commission book. So the sweet spot isn't until you start trading over 10 of them.
This is why we like having you on the show, Alex. You tell it like it is, regardless of where you're sitting or who's cutting your check at the moment.
and then I got a guy with a coat and tie who calls me 10 minutes later and says, who the hell are you?
The listeners appreciate it, though. You're stepping out on a limb for them, Alex, and they like it. Now, our next question actually gets to that, but I think before I get into that, I'm going to kind of reiterate what you're thinking there, Alex. It's interesting. You mentioned the pricing and how there's some sort of friction out there, and I would have to agree. Just from the scuttlebutt I've been hearing, we talked to a lot of different participants in the marketplace: retail, institutional, advisor, exchange, what have you. Everyone in the business we kind of interact with on some different level. And the one narrative we've been hearing back again and again and again, the one question we've been hearing and receiving time and again from our readers and our listeners, and I can't recall any other time where we've seen such a clear and concise narrative on a new product, is about the pricing. Is what's the deal with the pricing? Why am I paying the same rate? Why am I paying the same rate? That seems to be an ongoing concern. So I would guess, just from the volume of inquiries we've received on that someone's going to have to break ranks on that relatively shortly, because it's just too much inertia out there. And I don't know if the minis will really reach their true potential until someone does that. Speaking of the potential of the minis, we have a question from Mr. T-Box. He writes, what do you guys think of the minis so far? A related question. Commissions are high for contract size and the spreads are wide. Are they worth trading, or should we wait and see? And this kind of dovetails on what we were just talking about there, Mr. T-Box. Hence the reason that I threw it into the old mailbag today. But, this kind of gets into what we've been saying about minis for a while now, that they're very interesting. They've been very theoretically intriguing for a long time, heck, since they were first really being bandied about in earnest a year ago at the Options Industry Conference. It's been a pretty quick turnaround for this new product to hit the market. At the time, they were really pretty much couched as mini apples. The need for that has somewhat come off over the past year, hence some of the demand has slacked a little bit for these products. And of course, all the other issues we just outlined, the commissions being a big problem. No one's really gotten a handle on how to really price these things. The market makers clearly haven't gotten a handle on how to include these in their books yet, in their market making, because the spreads are just atrocious. When you factor in, you're paying full price for these contracts on top of the fact that you're getting squeezed at least another 5 to 10% in the spreads on these contracts, you're really paying a sizable transaction cost for these minis. And it really takes not only a sizable number of contracts, but a significant amount of premium if you're selling to really make any trade in the minis worth your while. So that's a significant problem. I know the industry was really kind of banking on these to be the panacea, the savior, the saving grace for the business going forward. They were counting them the same as big contracts, even though they're 1/10 the size. So that was a little bit of gaming the system there to try to help boost the numbers as well. So a lot of hopes were riding on these products, and so far they really haven't delivered, primarily because there's still some systemic issues involved with how they're being utilized. So for right now, I agree with Alex. I certainly think that if you're going to do a lot of contracts in a small name, the minis might be the way to go. It depends. But if you're going to do more than, let's say, maybe that sweet spot is between 11 and 20. If you get beyond 20, you're probably going to look at the big contracts, be much more efficient, and also the spreads. You really have to watch that with these minis. Every mini I've looked at, every mini I've discussed with our readers and our listeners, all of them, I've really been hesitant to pull the triggers because the spreads are enormous, substantially larger than what we see in the big contracts. So even more than the commissions, I know everyone fixates on commissions. Everyone really needs to look at the spreads, because if you're chasing bids and offers on these things and they're very wide. Another thing we've seen in the minis too is a reluctance to improve those markets. I mean, they're very wide for a reason, and then typically if you come in on the tight option, on the bigger options, someone will step up and you'll have a reasonably decent chance of getting filled. In the minis, not so much. You really kind of have to almost hit bids and lift offers to get done out there. So it's a dangerous realm to try to execute in, which is why I tend to steer clear of the minis, at least for now. Uncle Mike, we haven't heard from you on the minis in a while. Where do you come down now a few weeks in on these products? Are you using them at all? Are you recommending them to your clients? What do you think about minis here?
Still not in them yet. I still like the idea of it, but it's kind of the same thing in that I want to see a tighter bid-ask spread. And for me, just because of the fact that we're doing this with larger numbers of contracts than the typical retail trader would, I have uses for them just from the standpoint that I have clients with where normally I would have 150 shares of GLD or something like that, but I'm keeping them down at 100. Those would be situations with which I would use them. I have an institutional commission rate, so I'm kind of in a different world than a lot of the retail clients from that standpoint. But with that in mind, it's still, if the bid-ask spread doesn't make sense to do it, then I can't justify doing it.
Yeah, at the end of the day, that's what it really comes down to, is if the bid-ask spread is too wide, commissions are moot at that point. You just can't really do the trade. Alex, I'm guessing, I think we just said that you kind of come down in the same realm as Mike and I.
Yeah, and we do our share of it here, and Schwab does a good share of it. And, we'll be competitive from a commission standpoint. But, overall, to both your points, you got to look at aggregate friction. And friction isn't just transactions costs. And it's what does it cost you to get in and get out? And I expected better markets than this. And I mean, it is the catch-22. Market makers will always say, if you give me paper, I can give you tighter markets. And customers will say, I won't trade unless I see tighter markets. But, the screen market is the market maker advertising. And if those spreads are too wide or too generous, there's other ways for small investors to consider accomplishing some of the same things. I mean, instead of buying Apple or Google, I buy a Deep, if I want to bring my costs down, and then I spread options against that. There are a lot of ways to do this. And so far, the experience overall has been okay, not fabulous, not overwhelming. It hasn't been awful. I can tell you one behind the curtain story that there was really exciting volume the first day of trading, and I'm getting old. I forget if I've told this on the show already. Turns out a bunch of that was an error. Was someone who was trading minis who thought they were trading full-size contracts. And that was kind of funny because in the community, we were all envious because all of a sudden somebody was doing a lot more volume than us. And then we found out it was a mistake. And, we're all worried that we're going to have to go to our bosses and hear the story about, well, the other brokerage house is doing 5 times what we are. What's going on? So everybody needs to sharpen their pencils here. And as I say, we're looking at it, but we also need to see crisper markets. If we don't see crisper markets, if we don't see more names, then this product is going to really struggle.
All right, and that's it for our mini rundown, our mini roundup here on the old mail block. And since Alex said it's time to sharpen your pencils, it's a good time to do just that, listeners, because we're heading into the strategy block.
The strategy block.
All right, listeners, that regal tune means it is time once again for Uncle Mike to come on down from on high and put on the old smoking jacket and recline by the fire, brandy tumbler in hand. and dispense his options, wit, and wisdom. And it has been such a busy day. This should show you, Uncle Mike, what a busy day it's been on the street. It's been such a busy day, such just a sea of red out there that my birdies have been scattered to the winds, and I literally have no idea, no sneak peek of what you're going to discuss today. So I'm flying completely blind, sir. I leave it in your capable hands to hopefully not embarrass me too terribly.
Risk management versus market timing. I want to reiterate that again today. I talked about this on this segment a couple weeks ago, and I want to go through this again. I think I had mentioned another rep that was doing the death hedge we had talked about with the annuity. And once again, I have no issues with annuities. I just have issues with misinformation and misleading clients. But anyway, what I want to go through today, there's a process that a lot of financial planners do. It's called reallocation. And I started in the business with MetLife, about 10 years ago. I was there for a very brief stint before I realized that options were a much more fun thing than life insurance to deal with. Hence, my career began at Options Express. But with that in mind, I remember just looking at guys, how they would do what's called a reallocation of people's portfolios. And that, let's just say that theoretically, someone's 50 years old and they had them in 50% stocks, 50% fixed income. And the general rule of financial planning a lot of times is whatever your age is, that is the percentage of money that you do not have in the stock market. So in other words, let's say that you're 70 years old. That means that no more than 30% of your assets should be exposed to the stock market. And so with reallocation, a lot of times what they would do is, let's say that the market would go up significantly. And if the market goes up significantly, and let's say bonds just theoretically stayed the same, or bonds, fixed income, or something that's non-stock market related, non-correlated, something boring, so to speak. If that stays the same, then you're going to have a greater amount of money exposed in the stock market. So reallocation dictates that you need to move money from the stock market into your boring section of the portfolio. Whatever the boring section may be, everyone's going to have their own answer for that. So what I want to go through today is how I like to do that and why it makes sense. A while ago, or going into this year, we were actually in long a call option on SPY around, I forget if it was the 145 or the 140s. I could dig it up, but I forget what it was. And then when we hit the new all-time highs, we had actually made a significant amount of money in this call option. Now, keep in mind, folks, this is because of the fact, and this is retirement money that we're talking about here, because my allocations dictate a lot of times a very small percentage of money into call options and a larger amount of money into quote unquote boring investments. So taking the principle that I learned from MetLife, instead of taking money out of the stock market and putting it into the bond market, I just rolled up my call option. And that, folks, is what's known as risk management. There's a difference between risk management and market timing. There's percentages with which I look for. There's things with which I'm looking to do. And with that in mind, when it comes time to do that, I rolled up my call. It's just that simple. Implied volatility was very low relative to where it was. Stock market was at all-time highs. And so it was that rationale that led me to want to roll up the call option. Not because I had a gut feeling, not because I'm looking at the double tops, not because I'm looking at RSI stochastics or fundamentals of the market or anything like that. It's just the bottom line is that you need to protect your money. And when the markets come up, what a lot of people don't realize is that the market's not going to go up forever. And then the second thing that a lot of people don't think about when you're in the trenches of battle, at some point, if you want that money, you're going to have to sell that stock at some point. Now, the only time you're not going to have to do that is like maybe you're planning to pass that stock on to your children and you want to get the step-up cost basis on it upon death. Maybe that's a different scenario, but it's still money that's there. Yes, it's paper money, and yes, it's technically unrealized losses or unrealized gains, but folks, that's money. So what risk management dictates is that you need to protect gains. Now, on a day like today, how is this benefit? Well, in the SPY call, we rolled up that call option, and we're not getting hit so badly on that SPY call. It's actually technically a diagonal spread that we're in right now because we've been selling calls against it, but we're not getting hit that bad because of the fact that, number one, we're long premium. And the long premium, because of the fact that implied volatility has gone up so much, has actually helped the cause somewhat today. Now, obviously, it's a losing position. I'm not trying to deny that. But my point is that we manage the risk on it. We're not getting hit that bad today. Let's talk about two of my other positions that I talk about on the show all the time, gold and silver. I am a hopeless long-term gold, silver, and stock market bull. Love me for what I am, so to speak. And with that, though, risk, just because I'm that, doesn't mean that I'm immune to risk management. We need to manage risk on this. Now, with gold and silver, I've been talking about my gold silver collars on this show for years. And what happened on Friday, we're long GLD, and we're also long the 150 puts on GLD. So with the 150 puts on GLD, I think we paid like $2 for them. The fact that we only paid $2 for them, and this is out in June, we have protection from 148 to 0. Those $2 and some change. I forget the exact amount, and I don't have my screen up right now. But because of that, we've missed out on over 10% of this downturn. The accounts really didn't move that much for us this morning. So with that in mind, one thing that I'm looking to do at this point, this is when I have to reallocate again. I have to hold true to my long-term bullish bias. Now, I'm planning on doing this tomorrow just because of the fact that we had such a ginormous move today. This is when I step in and say, okay, with this large move with which we've had today, when do we roll the put down? It's not going to be today. I actually called one of my clients earlier in the day and was telling him about the situation. And I said, okay, probably about 2:30, that's when I'm going to make a decision on whether we roll down today or tomorrow, and he was fine with that. And with what happened out in Boston, I decided not to roll down today. That was kind of the main thing that put me over the top, I would say. So whenever a put is this far in the money, a protective put, I even said earlier in the show, I'm in a glorified cash position right now, or a complicated cash position, basically. So if gold or silver go up or down tomorrow $1, one way or the other, it's really not going to affect the portfolio that much. But at this point in time, this is when we roll down the puts. And for some clients, we're actually going to buy more shares because of the fact that it's gone down enough to where we can do it. This would be a case to where I would look into the minis, in that for clients that had perhaps maybe 100 shares of GLD. So I have some clients with 100, some clients with a whole lot more than 100 shares. But because of the fact that we have such a wide bid-ask spread right now, I can't justify doing it. So with that in mind, what I want to emphasize, folks, is that days like today don't have to be heart attack days. And by putting in the risk management, you have the ability to sleep at night knowing exactly, well, this is what I can lose and this is what I can make. I like being able to sleep at night. Now, granted, when I'm rolling things for millions of dollars worth of client assets during the day, I will confess that sometimes I don't go to the bathroom as often as I should. But my point is that we have a plan for no matter what happens. And that is the strategy for today.
Thank you for that, Uncle Mike. Words to live by on a day like today when the bottom seems to be falling out of everything. And now we're going to keep on rolling to our final segment, Around the Block.
Around the Block.
All right, and welcome to Around the Block. This is, of course, where we keep you in the loop on what we're watching here for the rest of the week. And as I said at the top of the show, at the end of last week, on last Thursday's show, we discussed earnings, and earnings was really the key story. Of course, macro events have somewhat superseded today. We'll have to keep an eye on the futures and how we open tomorrow. Like I said, I have a feeling this might be the continuing trend, at least for the early part of the session tomorrow. But moving past the macro events for a minute, if we can be so bold, there are quite a few other events that may contribute to what we're going to be watching for the rest of this week, including quite a bit of earnings. As Alex suggested, the big tech earnings palooza kicks off tomorrow with Intel closing today down like just about everything else on the street today, down about 1.5% to about 2140. Looking here at this 21.5 straddle, trading about 90 cents at about $1. So pricing in not the most aggressive of moves. And that seems to be about right for Intel and what it's been trading of late. The stock not exactly having too much of a range, dipping down to about 19.5 back in November before rallying actually all the way up to nearly about 23 and then coming off again. So it's been a little bit range bound over the last 6 months. If you're interested in the tech realm, this is one to kick you off. We also have Goldman Sachs tomorrow if you're looking to get into Goldman Sachs. Unfortunately, you missed your shot because they are actually before the open tomorrow. They closed today at 146.46, down about 1.8% as well. Another one coming out before the open. Then, of course, we have just a series of earnings rest of the week. Microsoft on the 18th. Chipotle, a.k.a. the stealth Apple, on the April 18th. Not so much stealth anymore. Google, Uncle Mike's big watch and see name, on the 18th as well. Uncle Mike, now that Google has broken through 800 and since retraced aggressively, any outlook to get back into Google? You want to see it go back up to 800 first?
Still want to see 800, so it didn't. I felt I missed it at first, but then it came back for me, but I want to see it get moving before I like it.
It's playing the foul seductress to you right now, tempting you to get back in.
It is. It's one of those it just keeps coming by me. It's a cruel mistress, I tell you.
And so that rounds up most of the big earnings we have for this week. Oh, of course, IBM on the 18th as well. It's Tech Palooza. If you're really into any of the tech names this week, then that's the bulk of them. The only one that's really missing is some fruit company, and no one really pays attention to them much anymore anyway, so we can kind of just skip them. Alex, anything catching your eye for the rest of this week?
Just really what you talked about. It's earnings, and it's pretty much a dozen of the important names. Everything from, as you pointed out, Intel, IBM, Coke, Bank America, Microsoft you mentioned. I'd also be watching the 10-year, and if that thing really gets into the 1.5 yield area, this market's going to have a difficult time. I'm watching stuff ticking now in some of the after-hours sessions, and the blood is still out there. I mean, nothing seems to be ticking back up. I would look at macro events. I know that sounds like a broken record, but when you come in the morning and Europe is open, look at what's going on in their market. The afternoon when Asia is open, especially what's going on in the yen. Say today was a difficult day, but the bad news is it's easy to explain by being a macro event. It looks like oil could lose $4 by the time the trading day is over. So it's all economics right now.
Yes, unfortunately, that cruel mistress, that dismal science is in the driver's seat these days, and not much you can do about that. Uncle Mike, anything else catching your eye for the rest of this week before we wrap up here?
No, I'm watching the Boston Marathon news tonight. I want to see, my thoughts and prayers go out to everyone in Boston, and want to see what happens with that, and just being careful right now when the market's this high and we have low volatility like we did. It's a time to be careful.
Definitely a time to be careful, and it's always, of course, difficult to take any sort of economic slant when looking at an event like the Boston Marathon where there's so many more important things at work, but of course there is an impact to that as well that has to be accounted for. So difficult stuff going on there in Boston. We'll keep an eye on that, and hopefully this headline I'm seeing right now will be the extent of the carnage we'll see coming out of Boston. Hopefully, we'll see. So on that very, very sad note, we're going to close out this week's episode of the Option Block. Of course, the boys from Option Pit couldn't make it. A lot of stuff going on over there today, so perhaps I'll toss them a quick plug just to say if you want to learn more about what they have going on, surf on over to www.optionpit.com and check out all the great stuff and the blogs and the alerts and the Option Pit Live, and of course, their events coming up as well. And Uncle Mike, what is coming up, if anything, this week for the old webinar train?
Decided to take a break for this week. Wanted to get something booked today, but just with everything going on in the marketplace, didn't get a chance to do it. So we are taking a break from the webinar train this week, but we should be up and running again next week.
I can't imagine anyone will hold that against you this week with so many other things going on. Really kind of hard to grab anyone who's any good guests from an economic perspective this week with so many other things grabbing their attention. Well, Mr. Alex, last but certainly not least, what is coming up in the land of OX?
2 interesting webinars on Wednesday at noon Chicago. We're doing a futures webinar, and for those listeners who haven't looked at futures or futures options in some of these products, especially in oil, where the ETFs and the ETNs really don't give you good tracking, look at what you can do in the futures and the futures options market. I'm doing an Idea Hub webinar after the close on Wednesday, and I'm looking at an Idea Hub right now, and it's got 600 ideas in it, but some of it is driven by earnings season. Friday, 1 p.m. Chicago, we're doing a webinar on charting, especially for people who are novices to the charting environment. We're going to talk about our new streaming charts. And again, I'll give you a little behind the curtains look. The brokerage community has had some challenges in the last few weeks with the new Java updates and the new Flash updates. And here we think we've got some of that stuff finally locked down. But we're going to be revisiting our streaming charts and then just watching the world, watching macro events for the rest of the week.
Thank you for that, Alex. And of course, last but not least, I want to remind all of our listeners out there, if you're going to be in the Chicago area next month, exactly a month from today, actually, May 15th, then we're going to be holding our first Unusual Activity Forum right there at the Chicago Board Options Exchange. If you like what we traditionally talk about in the odd block and diving into all that fun stuff, how to find it, how to filter it out, how to separate the wheat from the chaff, and then what to do once you find it, then by all means, you want to check this one out. I think it's going to be pretty interesting. We've lined up a great crew of speakers. I, of course, will be there, as well as Mark from Option Pit and Dan from Market Taker and Henry from Trade Alert and a bunch of guys from Live Vol, guys from Option Vision, a bunch of great participants there to really dive in and speak about a topic that really no one's ever held an event before that I've ever seen about this specific topic. So it's very unique stuff. Of course, we're throwing in a bunch of other great stuff. And floor tour, see all the trading pits before they're gone, because they're not going to be around too much longer if we keep doing this event. Who knows how much longer we can offer the floor tour. A lot of great freebies on top of it. So surf on over to theoptionsinsider.com/events. We've updated the roster, updated the registration bonuses. We're really kind of going overboard with getting you value for that $99. So $99 in Chicago, May 15th. Be there or be quite sad because you missed out on an epic event. And of course, all of us here on the Option Block All-Star panel want to thank all of you out there in the listening audience for downloading and streaming and subscribing to this show. And of course, writing in with your excellent questions. Keep it up. And we'll see you next time right here on the Option Block.
Become a part of the Option Block. Just visit www.theoptionsinsider.com/forum to post a question for the hosts. You can also submit questions to twitter.com/optionblock or leave a voicemail at 312-544-9356. Make it interesting and your question just might make it on the air. The Options Block is property of the Options Insider Incorporated. All rights reserved. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.